Dear students and scholars, welcome to this foundation lesson on ASC 340, Other Assets and Deferred Costs. Today, we are not just asking what a deferred cost means, we are asking the real accounting question. When does a cost deserve a place on the balance sheet? When must it go straight to expense? How is it amortized or remeasured? And what exactly appears in the financial statements? In this first video, we focus on ASC 34010 and ASC 34030. Contract cost assets under ASC 34040 will come in the next video. Let us begin with the cost question. ASC 340 is not a parking lot for expenses that management does not want to recognize today. A cost can be deferred only if it passes the gate. There must be a future benefit. The entity must control a right or resource. Recovery must be expected, and the correct ASC topic must support recognition. If even one of these gates fails, the cost is expensed in the period incurred. In simple words, deferral is earned. It is not a comfort blanket for nervous profit numbers. ASC 340 has three different zones, and we must not mix them. ASC 34010 deals with prepaid expenses and selected pre-production costs under long-term supply arrangements. ASC 34030 deals with insurance and reinsurance contracts where risk transfer is absent or incomplete, so deposit accounting may be required. ASC 34040 deals with costs to obtain or fulfill customer contracts, and that is strongly connected to ASC 606. In this video, we build the first two zones clearly, so the contract cost model in the next video becomes easier. Before measuring anything, classify the transaction. This is the most important practical step. If the item is a prepaid service or right, it may become a prepaid asset under ASC 34010. If it is a supply arrangement cost, the answer may be expense, a tooling asset, or a reimbursement asset. If it is insurance without risk transfer, the answer may be a deposit asset or deposit liability under ASC 34030. If it is a customer contract cost, we move to ASC 34040. Wrong classification leads to wrong measurement, and wrong measurement leads to a financial statement that may look neat but is technically wrong. Now let us discuss prepaid expenses. A prepaid expense arises when cash is paid before the related benefit is consumed. The initial entry is usually simple: debit the prepaid asset and credit cash or payable. The asset is classified as current when the benefit will be received within the normal current period, generally 12 months from the balance sheet date. Then the cost is amortized systematically as the benefit is received. The income statement does not take the full cost immediately because the entity has not consumed the full benefit immediately. Let us apply that with DataRail. On January 1st, 2026, DataRail pays $24,000 for 12 months of cloud infrastructure maintenance. The entry on January 1st is debit prepaid maintenance $24,000 and credit cash $24,000. Because the service benefit is received evenly, each month DataRail records debit maintenance expense $2,000 and credit prepaid maintenance $2,000. After March 31st, 3 months have passed, so expense is $6,000 and the remaining prepaid asset is $18,000. By December 31st, the prepaid asset becomes zero because all 12 months of benefit have been consumed. Next, we move to pre-production cost in long-term supply arrangements. These costs require judgment because not every cost incurred before production becomes an asset. Product design and development costs are generally expensed as incurred. Supplier-owned molds and tools may be capitalized as long-lived assets if they are not research and development under ASC 730. Customer owned tools are usually expensed unless the supplier has a non cancelable contractual right to use the tool. If the customer gives a legally enforceable and measurable reimbursement guarantee, the supplier may recognize an asset. The key is to identify what the cost actually created and which ASC topic controls it. Consider the MetroAuto example. MetroAuto enters a 5-year supply arrangement in 2027. Prototype design costs are expensed because design effort alone does not create a separately identifiable asset under this model. A supplier owned production mold may be capitalized because MetroAuto owns it and expects to use it over the supply arrangement. A new technology experimental die is treated as research and development expense because ASC 730 applies first. A customer guaranteed reimbursement is recorded as an asset when the guarantee is non cancelable, legally enforceable, and reliably measurable. Same project, different costs, different accounting treatments. Now we turn to ASC 34030 and insurance risk. Normal insurance accounting works only when real insurance risk transfers from one party to another. Insurance risk includes timing risk and underwriting risk. Timing risk is uncertainty about when cash flows will occur. Underwriting risk is uncertainty about how large the cash flows will be. If both are genuinely transferred, normal insurance accounting can apply. If risk transfer is absent, incomplete, or uncertain, the arrangement may not be treated like a normal premium revenue and claim expense model. When an insurance or reinsurance contract does not transfer significant insurance risk, deposit accounting becomes the key idea. The premium received by the insurer is not automatically premium revenue. Instead, the cash exchange is treated more like a financing arrangement. One side records a deposit asset and the other side records a deposit liability. Income recognition is deferred until the ultimate premium or income effect is reasonably estimable. This prevents an entity from calling financing type cash inflow revenue before the economics support that treatment. Measurement under deposit accounting has two stages. At inception, the deposit balance is measured using the consideration exchanged, reduced by any premiums or fees the insurer is entitled to retain, regardless of experience. At each reporting date, the deposit is updated using an effective yield approach based on actual cash flows to date and revised expected future cash flows. The updated carrying amount appears on the balance sheet, and the interest income or interest expense effect flows through the income statement. So, even though it is not normal premium revenue, it still has reporting effects over time. There are also special risk patterns. If only underwriting risk transfers, the entity generally carries the deposit balance until a reimbursable loss occurs and can be measured. Then the deposit is remeasured using present value of expected future cash flows related to that loss, and the income statement reflects the change. If the risk is indeterminate at inception, the entity continues to gather information using the open year logic. Once enough information exists, management determines the proper model. If deposit accounting is required, the change must be documented carefully because it can affect accounting change treatment, audit evidence, and disclosure support. Let us collect the common traps. First, do not call every deferred cost an asset. A cost needs future benefit, control, recovery, and support from the applicable ASC. Second, do not ignore the benefit period for amortization. Third, do not capitalize product design costs too quickly. Fourth, do not treat no risk insurance cash as premium revenue. Fifth, do not apply ASC 340 before checking related topics such as ASC 730, ASC 606, or ASC 944. In exams and audits, many mistakes start because someone jumped to measurement before doing classification. Here is the final memory board for video 1. Prepaid costs are recognized as assets and then amortized over the benefit period. Pre-production costs may be expensed, capitalized as supplier-owned tooling, or recognized as reimbursement assets depending on the facts. No risk insurance arrangements lead to deposit asset or deposit liability accounting, with remeasurement through the effective yield method where applicable. The discipline is simple: classify first, measure second, report third. In the next video, we move to ASC 34040 and study costs to obtain and fulfill customer contracts. If this lesson helped you, please like the video, subscribe to the channel, support the course, and share it with colleagues who are learning US GAAP carefully and seriously.